management team. We've acquired a project in northeastern Brazil called Pedra Branca, and it is in Ceará state. There's been a lot of money that's been spent by previous operators on this project. We estimate over $30 million US in terms of exploration, drilling, geophysics, and other really important critical information that will help us with the development. It's a large package of ground. I'll show you a picture in a second. And right now, what we're working on is building on the initial over 1 million ounce resource at the project through exploration and development. There's just a picture of the area that the project is located. You can see here on the left-hand side, upper left, that's Fortaleza, a town of over 3 million people. There's an international airport.
The really recent storm that gold faced is really related to rate adjustments. But before we get to the latest days of trading and explain why we had this weakness in the gold price, let me briefly remind you that gold is a cyclical asset, and try to forget for a minute the notion of hedge. It's before being a hedge, it's a cyclical asset, and therefore gold mines are cyclical. And the graph that you have here right in front of you shows it very well. This is a graph that goes back to 1985, and it's one gold mine index. It's the Philadelphia Gold Index. It could have been another one, and you would have had basically the same pattern.
The general environment remains positive for gold also next year. The ultra-expansionary monetary and fiscal policy is unlikely to change despite upcoming vaccinations. Governments and central banks will continue to be required to cushion the negative effects of anti-corona measures on the economy and the society. If the necessary additional fiscal stimulus measures are not adopted in time due to resistance in the legislative process, pressure on central banks to step up into the breach would increase. Possible options would be further interest rate cuts, if this is still possible at all, as well as an extension of bond purchases to the point of controlling the yield curve along the lines of the Japanese model.
Here you can see an interesting chart from Monday where there was a mysterious dip down in the price with some heavy volume, followed by just hours later another spike up in the price. So I'd remind people that a lot of this is traded in silver. But in the end, is any of this important? What does it all really mean? And I guess I'd put it in the context that, you know, if you want to run a fund or go to trade on Wall Street or a short-term market in nature, by all means, I've done that, and there's, I don't know, I guess good and bad to that. Although for the folks who are sitting out there and watching and have the benefit of being able to approach this from a long-term perspective, I think it's actually quite a glorious, rare situation where not only do you have a chance of an extremely high rate of return, but given what's happening in the world, my belief is that if you do have the advantage of patience on your side, you have a high probability of reaching that ceiling. Why would that be? Well, I know we just had the election here in the US. Unfortunately, I couldn't tell you who won. I haven't figured that out yet.
In gold, classic pattern over the last 10 years, a top in summer, August or September, and then a low around November, December, and it played out beautifully so far. And what you now usually get, I mean, statistically, the probability is very high that you will get a nice rally into spring of next year. So I think just from that perspective alone, it's time to be bullish again for gold and silver. I have been very patient and warning over the last 4 months, and I have changed my mind now during the last 2 weeks. I think it's time to be a bull again. I think gold and silver and also the mining stocks should at least see a rally towards end of February, early March, maybe even longer into spring, before we get any more significant pullback again.
What else have we seen that's positive this year? We've seen, for the first time since 2013, we've actually seen a rebound in the jewelry market. The major driver was China. We've seen a big pickup there. A lot of that has been on the back of new sort of marketing campaigns, new jewelry design that's been rolled out in China, and we expect that positive demand growth within China to continue into next year. We're actually expecting jewelry demand within China to hit a 3-year high next year. And just focusing on China for a moment, I mean, China's platinum imports have absolutely surged this year. They're up around nearly 20% at 2.1 million ounces. Some of that obviously was reaction to the price fall in the second quarter, and also to a certain extent driven by supply concerns given what was happening in South Africa.
I think the precious metals will be the premier choice. Gold in particular, as it was outlined, relentless printing of money will continue. Interest rates will remain at zero, below zero, and so there's no opportunity cost of holding gold. But also like silver, which is still rather cheap versus gold. I think gold-silver ratio in the high 70s. It came off quite rapidly from the peaks in March, but long-term average is slightly above 60, and it could also drop way below that. Also with possibility that more green energy policy with Biden, who said he would like to ramp up solar installations big time next 5 years, where silver is also used. There's a lot of reason why to be bullish on silver, I think.
I'm even more positive on silver, and Chris knows that. I think it's a good time now to add to your positions, preferably if you can do it physically, because you've seen my chart, the gold ETFs. This is always a tricky thing. It's clickable gold. People can buy it fast, but they can also throw it out very fast, and then in a panic you sell your gold while there was no real reason to sell it, just because the market dropped a few percent. Of course, if you are an institution, that's a different thing, but for private investors, I always give the recommendation to really make sure that they have it in their own hands, and then it's much easier to ride these volatile times.
I think the Fed, in case anyone had any doubts of how the Fed plans to respond, well, what do you think would happen if the stock market goes down 2 or 3% in a week? I mean, you'd have Powell running in his pajamas to get there in the middle of the night to launch a package. Just had the debate. No one talked about cutting anything, and it's going to hit 30 trillion now. So yeah, I think you summed it up well, and it's not to scare people, because I don't think we have to be scared of this. I mean, it's when you shift from what we think is fair or should happen and just look at, hey, this is what's going on. It's not that I want silver to be the winner. It's just when I look at all the things that are out there, I mean, I don't know, we're going to buy negative yielding treasury bonds from the US government, leave that for a couple decades.
I mean, interestingly, and it's not really particularly drawn attention to, since the March lows, platinum has actually outperformed all the other precious metals and even the industrial metals. I mean, platinum from its lows has rallied by 70%. Obviously, you know, gold's pullback was considerably less deep in March than platinum faced. I mean, gold has rallied 25% from the March lows, and this is actually a repeat of what happened post the 2008 crisis, when for a 2.5-year period after 2008, platinum actually outperformed gold as well. So obviously,
the fact is that my point is that despite the fact that we don't have this nightmare type scenario, we don't need this kind of environment to have higher gold, silver, platinum, palladium prices. We could easily have imagine some fiscal and monetary policies triggering some kind of growth. I'm not saying that we're going to get to the 3% that we used to have, or 4%. We can dream about that, but the fact is that with just 2.5% growth, annual growth in the economy, those metals will do extremely well.